Hello and welcome to AI Market News by LM.
Before we start, a quick disclaimer. This video's audio is automatically generated by NotebookLM, an AI-powered tool.
The reference sources used in this summary are listed in the video description.
As this content is AI-generated, there may be errors in proper names, pronunciation, or unnatural speech.
And importantly, this video does not provide investment or trading advice. Please make investment decisions at your own discretion.
Okay, let's get into it.
Right, welcome back to the deep dive. We are jumping straight into the engine room of global finance today, really trying to cut through the noise and understand the key drivers moving U.S. and European markets.
Yeah, we've got a stack of synthesized news commentary, market data streams, originally meant for quick briefings, and they seem to show these two massive forces sort of colliding right now.
Absolutely. So our mission today, to distill those complex signals. We're talking central bank moves, Tokyo, Frankfurt tech earnings from Silicon Valley, upcoming economic indicators.
Exactly. Currencies, equities, sentiment, the economic calendar, the whole picture. And based on these prepared resources, we need to tackle that really sharp question in the market. Is this incredible AI rally, is it providing genuine sustainable growth?
Or is it just masking these profound geopolitical and policy risks? Risks that could, well, disrupt stability pretty quickly.
That tension is it's everywhere right now. It's the core theme.
It really is. And just a reminder again, as we dive into this data, this analysis is purely for informational purposes. It's not investment advice.
Definitely not. Okay, so where to start? Maybe where the optimism is loudest. U.S. equities, the whole AI trade.
Makes sense. U.S. equity futures, NASDAQ Q100 futures specifically, they saw a big jump, didn't they? Over 1%.
A significant jump, and it was directly fueled by those Q3 earnings reports from the mega caps. Think Apple, think Amazon.
Those results really felt like a validation almost of the whole tech premise driving things. Amazon Web Services, AWS, that was the anchor, right?
Huge anchor, reporting a massive 20% year-over-year growth. I mean, that kind of expansion is why CEO Andy Jassy is expressing significant confidence in their momentum going forward.
And Apple, too. Despite all the chatter, all the worry about supply chains that investors have had for months, they struck this fiercely optimistic note for the holidays.
They really did, forecasting double-digit growth in iPhone sales, basically telling the street, look, our hold on the consumer is exceptionally strong, even with those past disruptions in China.
It sounds like this unstoppable freight train. But when you look under the hood, beneath the surface of the indices, the input sources seem to suggest we're seeing a bit of a split decision.
That's a good way to put it. There's enough underlying demand, yes, to keep the rally afloat, for now, as the sources put it.
Right.
But investors are getting, brutally discerning. They're showing increasing discernment about how companies spend their money, the quality of the spending.
The quality of spend question. That's the pivotal caveat then.
It is, and you see this perfectly if you contrast Amazon and Meta. Amazon's showing profitability in the cloud now. That's a clear path of return on AI infrastructure investment, right?
Right, but Meta...
Look at Meta. Shares tumbled 11%. Their steepest drop in, 3 years? And it happened right after they announced plans to spend more aggressively on AI.
Which seems backwards. You'd think spending more on the hottest trend would be good news.
You would. But the market wasn't worried about the amount of money. I mean, Meta pulled off a record $30 billion high-grade bond offering. Capital isn't the issue here.
So what was the issue?
The market punished them because they demanded a nearer-term path to actually making money, to profitability from that spending. The message is loud and clear. We'll fund your AI infrastructure, sure, but you better show us the revenue soon or you're out.
So, okay, the physical demand side that ships, the infrastructure, that part is genuine.
Oh, yeah. The sources cite results from Samsung, SK Hynix. They've basically sold out their entire supply of advanced chips. The foundational layer, the stuff you need to build AI, that demand is real.
Undeniably real, then.
Undeniably. But here's the growing tension. Demand for chips is high now, but the market chatter, the whispers, are suggesting that maybe by the middle of next year, the fear could shift. Not from supply constraints, but from whether companies have collectively overbuilt data centers, creating a glut.
Ah, the classic boom-bust cycle worry.
Exactly. And that's why tracking sentiment, tracking the psychology is so critical right now.
Which brings us nicely to market psychology. We often talk about the fear and greed index. Maybe instead of listing every single component, we just talk about the concepts, what actually drives that index.
Good idea. Think of it like a quick check on extremes in the market. It looks at things like momentum. Is the S&P 500 way above its long-term average, its 125-day moving average? If yes, that signals greed.
Okay, and volatility.
Right, it tracks the safety net, you could say.
Yeah.
Is volatility, measured by the VIX, unusually low compared to its 50-day average? Low VIX often signals complacency, which points towards greed. High VIX, increasing volatility, that signals fear.
And the options market gives a good snapshot of behavior too, doesn't it?
It really does. We look at the put-call ratio. Are traders betting more heavily that the market will fall buying puts than rise buying calls? If that ratio goes above 1, it's distinctly bearish. It signals fear.
So these indicators together help us gauge if that huge NASDAQ U jump we saw is like rational confidence or maybe just euphoria getting ahead of itself.
Precisely. And currently, even with all these structural warnings we're discussing, the needle seems to be pointing more towards greed.
Okay, let's pivot then. From U.S. euphoria, maybe, to what feels like the sharpest macro risk out there, that policy divergence in the FX world, particularly the yen.
Oh, yen. Yeah, this currency story is purely about central banks driving the action. And it connects directly back to our first question about masking those deeper policy risks.
It feels extreme, doesn't it? USDJPY sitting firmly above 154. The sources mentioned it trading in that 153.65 to 154.17 range on October 31st.
It is extreme. And the core driver is just this massive chasm between the Federal Reserve and the Bank of Japan, the BOJ.
Even though Tokyo's core CPI came in hotter than expected, 2.8%, the BOJ just held steady.
Held steady, 7-2 vote. And offered absolutely zero new hints, no forward guidance on when a hike might ever come. They seem deeply dug in, focused only on downside risks to their economy.
And that just stands in such stark contrast to the Fed. I mean, the Fed did cut rates recently, October 29th, according to the sources.
They did cut, but Chairman Powell was very careful, wasn't he? Managing expectations, making it crystal clear that this cut does not guarantee another one in December.
Right, so the market's only pricing in what, like a 45% chance of a December hike? Or maybe a full hike by March or April next year?
Something like that. And that policy gap, you've got dovish Japan versus a Fed that's still signaling higher for longer. Relatively speaking, it's just explosive for the dollar-yen pair.
And it's led to this infamous 160 yen bet we keep hearing about. Hedge funds just piling in, betting on yen weakness.
Aggressively positioning for it, yeah. Betting the BOJ simply won't move soon enough, or maybe can't move soon enough.
And they're putting serious money behind it.
Serious money. The prepared information showed call options. Those are bets on a stronger dollar against the yen, trading at about 6 times the volume of put options. That's a huge skew.
Wow. And the market consensus now is spreading that USDJPY could hit 157 soon, and maybe even 158, 160 by year end.
That's the talk, yes. Targeting 157 within a month and potentially that really extreme 158, 160 yen range by the end of the year.
Okay, we need to unpack something here because that 160 level feels really significant. The sources mention analysts noting the use of something called reverse knockout options, RKOs, around that level. What exactly is an RKO and why does it signal this intervention risk?
Right, RKOs are a bit more complex. They're exotic options, but the key thing is they have a barrier level in this case, 160 yen. If the actual spot exchange rate hits that 160 barrier, poof, the option instantly becomes worthless. It knocks out.
Okay, so why would funds use them if they can just disappear?
Because they're cheaper than standard options. But using them signals a very high conviction bet against intervention before that level. If you buy an RKO with a 160 knockout, you're essentially betting the Bank of Japan or Ministry of Finance will not step in to sell dollars until or unless 160 is actually breached.
So the fact that these are being used heavily suggests traders are really aggressively betting against intervention, knowing their positions will self-destruct if the BOJ does act before 160.
Exactly. It shows just how extreme the risk-taking is in that market right now, really pushing the envelope against potential official action.
That dynamic really highlights the macro risk, doesn't it? Compared to that Euro-USD, the euro-dollar pair, has been Well, remarkably stable, trading around 1.15.
Very stable in comparison. And that stability brings us over to Europe, to the European Central Bank, the ECB. They also kept rates unchanged. Third meeting in a row now, following the Fed and BOJ pausing, but really for quite different reasons.
They actually have the data to back up their pause, it seems. Eurozone inflation for October came in at 2.1% year over year.
Yeah, down slightly from 2.2% the month before. That puts them right on the ECB's 2% target. And core CPI, stripping out volatile stuff, held steady at 2.4%. It suggests, maybe their disinflation effort has actually been pretty successful.
And the official comments reflect that?
They do. ECB President Christine Lagarde and also Austrian Central Bank Governor Martin Kocher, they both described the Eurozone economy as being in a good place. They even noted recent data like Q3 GDP turned out slightly better than feared.
So the key word for Europe is data dependence. They're not committing either way, hike or cut.
Not at all. They keep emphasizing this meeting-by-meeting approach precisely because of what they call an unusually high level of uncertainty. No pre-commitments.
And how do they see the risks?
They see the overall balance as quite balanced, actually. Downside risks, things like slowing global trade or weaker economic activity, they feel are pretty much offset by upside risks, like maybe new supply chain problems flaring up, or, interestingly, risks to financial market stability.
So it's the ultimate holding pattern, really. Just waiting for clarity. Clarity that the Fed and definitely the BOJ seem to lack right now.
That sums it up well. Just waiting and watching the data.
Which brings us perfectly to the incoming data. Before we wrap, we absolutely have to look at the upcoming economic calendar. We're pulling this from sources like investing.com. These numbers are going to either validate these central bank pauses or maybe force their hands.
Yeah, we really need to focus on Friday, October 31st, U.S. time, Eastern time. That day looks absolutely packed with potentially market-moving releases.
Top of the list has to be the core U.S. inflation report, right? 8/4 a.m. Eastern.
Definitely. We get the core PCE price index, that's personal consumption expenditures, month over month for September, plus personal income and personal spending numbers alongside it. And remember, the PCE, that's the Fed's preferred inflation gauge.
So everyone's going to be hanging on those numbers for clues about the Fed's December meeting.
Absolutely everyone. Then, following that, 9:45 a.m. Eastern, we get the Chicago PMI reading for October. Gives us a fresh look at regional manufacturing health.
And we also have Fed officials speaking.
We do. Key commentary expected. Fed's Logan speaks at 9:30 a.m. Eastern, and then FOMC's Bostic is scheduled for noon Eastern time. You can bet those speeches will be dissected word for any shift in tone after that morning inflation data.
And can't forget earnings. After the bell, on Friday, October 31st, big oil reports. ExxonMobil, Chevron.
Right, XOM and CVX. Given everything happening with global energy, geopolitical tensions, those reports will certainly sway broader market sentiment heading into the weekend.
Okay, so let's try to synthesize all this. Where does this leave us?
Well, it feels like AI optimism is still surging, right? Validated by those mega cap earnings, validated by genuine hardware demand from the chip makers. But that domestic U.S. euphoria seems built on, let's say, a shaky foundation.
Shaky how?
Geopolitical friction is still simmering, and you have this massive policy divergence we talked about. The most visible sign of that risk is just the extreme volatility in FX, especially dollar-yen, pushing towards that potentially dangerous 160 level because of the BOJ-Fed contrast.
Meanwhile, Europe seems calmer. Stability seemingly confirmed by inflation numbers hitting target, but still very cautious.
Cautious is the word. Paramount caution over there.
Okay, so that leaves you, our listener, with a final thought to ponder. The short-term euphoria over tech earnings, maybe the U.S.-China trade truce mentioned in some background sources, it seems to have bought some stability. For the moment, anyway.
Seems that way.
But given the Fed's reluctance to really commit one way or the other, and these systemic risks we see bubbling, those U.S.-China structural tensions are still there, the yen weakness driven by policy stubbornness, how long can this genuine AI demand keep outrunning that fundamental quality of spend question investors are now asking?
Yeah, what happens to the global risk balance when that incredible demand for chips, for infrastructure, finally starts to level off next year, as some are starting to predict?
Something for you to definitely keep an eye on.
Absolutely.
Thanks for watching. Don't forget to like and subscribe.